Hey everyone, and welcome back to another innovative investment idea. My name is Dave, and in today's video, we'll be taking a look at Lemonde, a new and disruptive company within the insurance space, to analyze its growth opportunity and outlook. Make sure to stay tuned until the very end, as I'll be going through some specific company news and analysis before finally giving my thoughts on whether the stock is a buy. Just a friendly reminder to hit the like button at the end if you enjoyed the video, but also the subscribe button if you're new to the channel to get notified of more stock market content just like this. So with all that said, let's dive right in. Lemonde began trading on July 2nd, 2020 on the New York Stock Exchange under ticker symbol LMND, Lima Mike November Delta, and had one of the most explosive IPOs in recent history, rising by more than 138% on its first day to close above $69 after initially being priced at $29 at the open. Although the stock has not continued its parabolic ascent, it has at least not come crashing back down to earth some 3 weeks later, like so many other overheated IPOs after an initial bump. But before we get into financials or discuss valuations, let's first understand what the company does and how their business model will either help propel them forward or raise further questions as to their long-term sustainability. So the core business model of Lemonde, for those not familiar, is to provide insurance to the masses, but by doing so in a manner which disrupts both the traditional underwriting and the claims process through the use of artificial intelligence and machine learning. It accomplishes this by replacing human brokers and insurance claims investigators entirely for the most part, with a confluence of 4 AI engines, which we will look at very shortly. Because the company has purposely chosen to operate in the cloud without a brick and mortar presence, as everything is either done online via their website or phone app, the target audience are generally millennials and the younger generation. This should signal to investors immediately that Lemonde can inherently only sell to a percentage of the entire demographic, but over time, maybe years from now, the growth opportunity could be vast as the younger generation matures and society looks at how insurance companies currently operate in the rearview mirror. The company also prides itself on the transparency of its operation. Lemonde only takes a flat fee of 25% off the top of every policy it underwrites, holds half of the remaining premium in escrow to cover any potential future claims, and passes the remaining half on to other insurance firms to help alleviate the burden of major claims and also divest itself from full-blown risk, known in the industry as reinsurance. At the end of each financial year, Lemonde donates every dollar left over from the 75% directly to charitable causes, which are nominated by customers during the underwriting process. In 2019, the company donated over $600,000 across 26 non-profit organizations. It's also quickly worth noting that Lemonde is actually a certified benefit or B corporation, a legal distinction awarded to for-profit companies to recognize their positive social and environmental contributions, an unlikely award for an insurance company, to say the least. This means Lemonde should automatically be a blip on the radar for investors actively searching for environmental, social, and governance, or ESG, investment schemes, or those simply seeking socially responsible investing companies. Lemonde claims that their underwriting process takes only 90 seconds, and the claims process is supposedly equally as efficient and takes 3 minutes total from initiation to payout. There's no paperwork, no lengthy contract to review, and any authorization signatures and payments are all done digitally. The products Lemonde currently offer include homeowner, rental, and pet insurance in the US, but it also has already begun expanding internationally and offers the same range minus pet insurance in both Germany and the Netherlands. One would assume that once it has sufficiently saturated these particular segments, the next logical step, in addition to greater geographical coverage, would be to expand its insurance offerings to include other areas such as business, travel, and car insurance, for example, and potentially even health and life insurance in the long run. There is certainly no lack of growth motivators or opportunities here. And by the way, the interactions demonstrated here, although seamless, are actually between a human customer and artificial intelligence entities. There are actually 4 of them, as mentioned earlier. The first is AI Maya, a virtual assistant that collects information, provides quotes, and handles the payments. There's also AI Jim, the claims bot, who for the most part currently handles roughly a third of all cases, but even when a case is passed along to a human due to complexity or needs to be reviewed because it has been flagged, the application is generally close to completion because AI Gym has already done a large chunk of the legwork. The assumption is that over time, AI Gym should get closer to 100% of the incoming cases as the machine learning improves with increased exposure to patterns and a large cross-section of possible scenarios. The third automated component is simply referred to as the Customer Experience AI and is an engine in the backend which feeds predominantly AI Maya information to help answer customer support queries and frequently asked questions. In the unlikely event that the bots cannot satisfactorily respond to a customer's questions or concerns, the platform is able to redirect the edge cases to an actual human operator. But clearly, the primary advantages here are that the bots can operate 24 hours a day, 7 days a week without rest, and when the knowledge base is sufficiently large and economies of scale kick in, it will cost Lemonade but a fraction of the overhead it costs other companies in salaries and wages. Finally, the last component of the artificial intelligence network, which Lemonade refers to as the Customer Cortex, is the Forensic Graph, which works primarily in conjunction with AI Gym to help predict, deter, and detect fraudulent activities utilizing the combined power of behavioral economics, big data, and AI throughout the customer engagement process. With such cutting-edge technology, it's not difficult to see why investors are so hyped for Lemonade, especially when we think about how entrenched and slow-moving the legacy insurance companies are, some of which are over 100 years old, and how extremely difficult it will be for them to pivot to the new disruptive approach that Lemonade is trailblazing. Of course, the easy and obvious comparison is to a company like Tesla and what it has been doing in the automotive space against the aging and established internal combustion engine automakers such as Ford. Now that we understand what Lemonade does and how they plan to go about achieving it, as an investor or potential investor, it's logical to wonder how much they make and what is the total addressable market of the insurance industry. Let's start with the latter. Insurance is an extremely broad industry with many subsegments, and according to the Insurance Information Institute, companies in the US alone wrote more than $1.2 trillion in policies in 2018, with a roughly even split between property and life. While companies such as MetLife and Prudential Financial top the chart within the life space, State Farm and Allstate are among the top players in the property and casualty space and are therefore the primary current competitors to Lemonade domestically at this early stage. There are so many statistics to rattle off here, such as the 2.8 million employees and the almost 10 trillion in total invested assets industry-wide, but needless to say, the insurance industry is already massive and amongst the largest in the country based on sheer turnover, representing an estimated 3% of US GDP on aggregate. Moreover, you would be mistaken in thinking it is a shrinking or dying industry, as according to Statista, the property and casualty market specifically has grown at a steady clip over the last decade, and there's no indication to think that will stop anytime soon. The $650 billion figure in 2019 we see here corroborates a roughly 50% split of the $1.2 trillion we saw previously, but we should also keep in mind that despite the gigantic numbers, Lemonade is also a threat to take market share away from international companies as well, as it has already shown that it is willing to expand into Europe, for example. So if we switch gears for just a moment and take a look at the global split for property and casualty insurance premiums, we see the US actually accounts for less than half of the pie, which tells us that the data we've looked at up until this point should only be considered as a launching point and on the conservative end of the spectrum. It is safe to assume that there is an enormous opportunity for both growth and disruption up for grabs if Lemonade can rise to the challenge. To be clear, I'm not suggesting that Lemonade will win a significant portion of this market share in the short term or is even a shoe-in for the long term, as there are also significant headwinds, but as part of my fundamental analysis process, if you've watched any of the channel's previous videos, is to always examine the total addressable market to understand where the ceiling is. But let's take a step back from industry talk now that we have some idea of the scale and take a look at how much Lemonade currently earns in revenue as a company. Here are Lemonade's income statements for the last couple of years, keeping in mind that because of its relative youth as a recent IPO, there isn't a significant amount of data to form a baseline. But the first thing we notice is that the total revenues for 2018 came in at $22.5 million, which grew to over $67 million in 2019, representing a 200% growth year over year, a tremendous number that should get many investors excited. The net losses of $53 million and $109 million for the same period are clearly less impressive, however, and the company has even stated recently that they expect that the net losses will continue to rack up in the near term as they continue to invest in R&D and grow the business. So as with every growth company, we are left to determine if the price we are paying now will be compensatory for the valuation we expect in the future. Lemonade also reported for the 3 months ended March 31st, 2020, revenues of $26 million and a net loss of $36 million. Assuming even a uniform rate of growth for revenues from Q1, since in a recent interview with Jim Cramer on Mad Money, CEO Daniel Schreiber declared that the pandemic has not affected their business in a material way, total revenues could hit roughly $100 million on the conservative end, representing a 50% growth year over year by the end of 2020. With revenue growth looking healthy, we turn our attention to the balance sheet, where it appears that management are doing a pretty solid job overall, maintaining total assets well above total liabilities at $400 million and $124 million respectively, and has steadily been increasing the cash on hand. There's not much else that stands out in particular here, so to wrap up the financials portions of this analysis, we should take a glance at the ratios, as it is always prudent to do so. Here we can see a huge disparity between valuation and current revenue, not surprising given the tremendous run-up since its IPO price of $29. Its price to sales ratio sits at 50, while its peers within the property and casualty insurance segment sit at somewhere around 1.5, and obviously due to having never turned a profit, there are no PE or price to free cash flow ratios to analyze and thus compare to other insurers. The takeaway so far then is that from an investment perspective, there is certainly risk that Lemonade may not be able to get its ballooning costs under control before they begin to turn a profit, despite the rapidly escalating revenues. The high price to sales valuation is also potentially a bit worrying at this point and should be taken into consideration by investors, especially when trying to determine a suitable entry point. Okay, so before giving my final thoughts on the stock, I also want to quickly touch on a couple of other areas. The first is the argument that artificial intelligence cannot adequately compete with human brokers. Back in October 2018, State Farm actually released a commercial featuring NBA stars Chris Paul and James Harden, where it openly derided Lemonade for its use of bot technology and artificial intelligence, with the subtext that its network of 50,000 human agents work much more empathetically and effectively to assist customers. Lemonade responded with their own campaign, which ironically was to pay YouTube to promote that very same ad on State Farm's behalf, with the accompanying message that it was absurd to mock technology so blatantly in an era where it is increasingly taking over so many aspects of life. In a blog entry from Lemonade themselves entitled The Sixth Sense posted earlier this year, the story of a customer from LA attempting to cheat AI Jim is explained. The man in question first filed a $677 claim for stolen electronics, which was quickly approved, but he proceeded to file another claim later in the year while attempting to alter his appearance with a wig and lipstick. Although the individual used fake details in a different account, AI Jim detected the anomaly based on details it had learned from the first encounter, potentially with face recognition as part of the dataset, and not only rejected the claim, but flagged the user internally. When the individual attempted to file a fake claim for a third time, in this instance with a pink dress, AI Jim immediately escalated it to the Special Investigations team, where the user was then presumably scrutinized by authorities for insurance fraud. The point of the story ultimately, however, is not to say that artificial intelligence is much better or worse than humans currently, or will detect cases that otherwise would have slipped through the cracks, because without question, a very experienced human agent would perform or at least match AI Jim in its current state, but the fact is that even machines are capable of learning and improving over time and should never be underestimated. In fact, one powerful metric that captures the improvement of AI Jim and Lemonade's forensic graph is a tangible decline in Lemonade's loss ratio over time. In the insurance world, the loss ratio is defined as the losses an insurer incurs due to paid claims expressed as a percentage of premiums earned. So if an insurance company pays out $200 in claims based on $100 in premiums it had collected, then the loss ratio would be 200%. The higher the loss ratio, the less profitable a company is. As we can see here on this graph, Lemonade's loss ratio has declined markedly from 166% in Q4 2017 to around 73% in Q4 2019. To put that figure in perspective, the industry average, according to KPMG's General Insurance Industry Review of 2019, is 68%, meaning that Lemonade is already getting quite close to the industry average through the use of artificial intelligence almost exclusively and with only a couple of years under its belt. Here's some food for thought. Between the years of 1996 and 1997, IBM's Deep Blue and then world chess champion Garry Kasparov squared off to determine if artificial intelligence could overcome the human mind. Although both series were heavily contested, Deep Blue ultimately won an aggregate, and this was a huge deal because up until that point, computers had never achieved such a feat and it was not even thought possible. However, if we fast forward 20 odd years later to today, it is said that even software running on home PCs can now regularly defeat even the top chess grandmasters consistently. Needless to say, it will be interesting to see how capable AI Jim will be in several years after it has had a chance to accumulate more data still, and if State Farm will be so quick to deride the abilities of bots and machine learning again. The last point I wanted to make before giving my final thoughts is the discussion as to how much leeway Lemonade has to grow unfettered in the insurtech space. The answer is plenty, but it certainly won't go unchallenged either. Detractors of Lemonade often bring up another up-and-coming company called Hippo, which is also ramping up operations and looking to IPO soon themselves. The argument is that they could prove a challenge in the short and medium term to Lemonade, as they essentially operate in a very similar manner, using artificial intelligence and big data to provide fast and cheap insurance. If we think about companies like Apple, and I'll mention Tesla again for the second time in this video, who were both given years and years to innovate products without real competition, the head start has been priceless and has afforded both companies tremendous reward even years on. While Lemonade is the first of its kind to market, it hasn't yet built much of a head start, unfortunately. Hippo is reportedly on track to hit 100 million in revenues in the next year, which is right on par with Lemonade as we have already looked at. It is operating across 29 states and is reported to have already amassed hundreds of thousands of customers, also in the ballpark of Lemonade's reported 425,000 customers for the year-end 2019, and on paper at least, a lot of metrics look to be quite similar, such as the number of employees and national coverage. While most might immediately conclude that they would jockey for position in the same niche they find themselves and diminish each other's prospects, it is important to realize that ultimately they are both out to disrupt the legacy trillion-dollar insurance market with all its aging players. The insurance industry is so large that there is more than enough room for two or even multiple significant players, such as what is already happening now today, and it wouldn't be surprising to see both disruptors thriving over the next decade. So now for my final thoughts on Lemonade. With a current market cap at about $4 billion and reported revenues of only $67 million in 2019, but potentially upwards of $100 odd million for the current year, there is certainly a huge number gap, suggesting a significant valuation bubble even after the recent price correction. Goldman Sachs analyst Heath Terry on Monday, July 27th, initiated coverage on Lemonade and immediately issued a sell rating, citing the exact same valuation concerns as covered in this video, and expects about 5 years of operating losses before breaking even, and will likely need significant injection of additional capital in the future to stay afloat. As a quick reminder, Lemonade had already been afforded $300+ million from Japanese investment management firm Softbank as part of its Global Vision Fund, which incidentally equates to about a quarter ownership of the company. So while valuation is a huge red flag, I do believe Lemonade is definitely sitting on a winning concept, has a powerful ally that can provide additional funding if it ends up in dire straits, and will be able to provide value to customers with its innovation. The only question is at what price and over what time period. It is true that fundamentals have become less relevant in the post-pandemic climate with such frothy valuations in general, but Lemonade will need to prove itself over a longer period of time by demonstrating it can continue to grow its top line and simultaneously find a path towards profitability. There is also a chance it could become one of those rare companies where valuation has and never will make sense, such as Tesla, which I have already compared to it in a couple of instances throughout this video, but only time will tell how high that chance is. I personally have not yet initiated a position in Lemonade, but it is certainly on my radar as a buy candidate, particularly as an investor generally infatuated with technology-related stocks. I will, however, abstain for the time being, and also suggest that those not yet with the current position do the same and wait for future evidence of improved metrics over the coming quarters. If at some point the stock suffers a significant pullback and ends up closer to its IPO price, or can satisfy one or more of the aforementioned criteria, it will no doubt find a home in my long-term growth portfolio. Finally, for those already with the position, Lemonade seems like an ideal hold candidate for the coming years despite potentially volatile times, as its future prospects are certainly bright and the risk appears to be well worth the potential reward. So that about wraps it up for this video. What are your thoughts on Lemonade and its future? Post them down below in addition to any other questions or comments. Also, don't forget to hit the like button if you enjoyed this video, and even consider subscribing to really support the channel if you haven't done so. Before I go, click on the top video here to take a look at my analysis of NIO, a high risk reward EV manufacturer out of China, or down here for a look at my current growth portfolio for the post-pandemic era. As always, thanks for watching, and I'll see you in the next one.